Hi, and welcome everyone to another Venture and Capital interview. Today, I am joined by the founder of Kashcade, Mr. Alex Simmons. Welcome, Alex.
Thanks, Steve. Good to be here.
Now, mate, what an exciting area you're in. So just before we sort of kick off, do you want to give a bit of an introduction to Kashcade on the whole?
Yeah, sure. So look, maybe it helps starting kind of with where I came from. So I spent a lot of time in business lending, trying to make business loans simpler and more accessible for traditional businesses. And so that's how Kashcade's come about. We're now trying to do the same to the startup and the tech world. So quite simply, Kashcade makes non-dilutive loans more accessible to startups. We keep everything really simple. So from the process of applying through to the concepts we use, the terms we give customers, and how they make repayments. We're really trying to make more capital more accessible to more companies. And so you don't need a network. You don't need to live in Sydney or Melbourne. You don't need to have a huge hype around your company. And you don't need to be a kind of amazing pitcher as a founder. It's all online. It's all based on the numbers. And then kind of additionally, because we're built on software, we can make kind of more value adds available to companies as well. So we're offering things like real-time insights and analytics. And we make it really simple and easy and flexible to actually access this capital from us, as opposed to kind of those businesses that are based on a traditional kind of manual process.
Gotcha. And just just give some examples. So some of the companies that you'd work with, what do you typically find are the most sort of common companies that are reaching out to learn about the service?
Yeah, so software and other tech companies. For us, we're focused in ANZ, so anyone with a kind of registered business in Australia or New Zealand. But stage-wise, they're typically post-seed, working towards either a second seed or a Series A or B or C, which really means they've found market fit. They're on that growth curve. They've found what works, and they've got a machine that kind of produces some return, and they're looking to lever that up. And typically, in terms of revenue, these businesses are doing kind of $500,000 to $5 million in annual revenue.
Fantastic. And for a company looking to participate, like typically, what is their end-to-end process? So you mentioned it's completely online. So they go online, they fill out a form, and then sort of what takes place from there?
Yeah, so it all starts with a conversation. And so, we have a half an hour conversation with the founder and either me or someone else, and we really get to know each other a little bit. What does the startup look like? What is their strategy? What are they looking to achieve over the next kind of short to medium term? And of course, we tell them a bit more about Kashcade as well. And so if it's a fit between us, they'll spend about 10 minutes getting connected to our software. And so they'll hook up their accounting and their banking and their commerce system, like Stripe, for example. And essentially that gives us all the information we need to make a decision as to whether we can fund them, how much we can fund, and on what kind of terms. From there, typically in about 48 hours, we give an offer back to them. And if they choose to accept it, they can draw money down either in tranches, in bits and pieces, or all at once, all through the dashboard. When they request those funds, it's sent to them immediately. So it's in the bank account either that day or the next 1 to 2 business days. So super quick. And importantly as well, as these businesses grow, we continually refresh our analysis of that business. And so all else equal, your revenue line's growing. We may make more capital accessible to you as well. And so we're really trying to make this a super low effort way of applying to get access to a different kind of capital.
Makes sense. And typically, how much is going into the companies when they go through the process?
Yeah, so our typical offer goes up to about 4 times the average monthly revenue. And the rest of the terms that come with that are also determined around like what the business profile looks like at the time. And so if I was to talk to those terms a little bit more as well, we charge a fixed fee as a percentage of what's actually drawn or what's used, as opposed to the kind of maximum offer we make them.
So just to put that in clarity. So say, for example, you say to a company, look, we're happy to allocate, $500K to you. The company may only draw down $100K of that $500K. That's as far as the capital that's being used.
That's right. We're really trying to make it as flexible as possible. We're all about capital efficiency. So a lot of these founders have plans that, they want to spend some in the next 3 months. They want to spend another amount in the next 3 months after that. And so we really try to work with them on that.
Gotcha. And the duration of the financing for the companies, typically, what do those terms look like?
Yeah, so founders can choose whether they want to repay the funds over 3 to 12 months. How those repayments actually look is you pay part of the loan back and part of the fee back every month in equal monthly repayments. And so if you think about it, it's how much you've actually borrowed plus the fee on top divided by the number of months that you're going to repay the funds over. And typically that's 12 months, I would say. And so it ends up being about 12 equal monthly repayments.
And when the companies are coming to you for the service, do you typically find they're in the process of they're thinking about this as a potential bridging around whilst they achieve additional milestones to sort of get to a higher equity valuation, or are they just looking to go through this path instead of actually raising equity capital?
Yeah, so it's often a combination, Steve. We've got a lot of companies looking to simply extend their runway and grow in preparation for the next equity round, or actually quite a lot we're seeing at the moment to help them get to break even. We're also seeing a different camp of customers looking to basically lever up the growth machine that they've created. You know, they've produced something that turns $1 into $1.50, and they're going, we know this works. We want to fuel that with additional capital. We're also seeing other founders simply looking to minimize dilution in the current round. So they might do something like raise 80 or 90% equity and 10 to 20% debt from us. And then the final kind of use case is where founders have just raised an equity round. They've got a really healthy balance sheet, a lot of runway, and they look to us to top up with additional non-dilutive capital. And the reason they do that is basically to preserve that precious equity capital that they've just raised, preserve it for as long as they can, basically, and use the current position of strength to get better terms from us. Because typically the more runway you have equals the more capital you can actually borrow and on kind of better terms, better rates.
Makes sense. And for you in working with the companies, you mentioned that you obviously, over a period of time, you get to know the business, you get to understand it. And do you also, is it purely just revenue-based financing, or do at some stage you look at some of these companies and think, okay, this may be a potential equity investment, or do you look to put warrants in so that you can potentially invest down the track? Is there any of those sort of, I suppose, creative features in it?
So we are a purely non-dilutive capital solution. We feel very strongly about not taking any sort of equity position, whether that's warrants or options or otherwise. In saying that, we do work with these founders over time, and we're all about helping them get better access to capital, just like your business is as well. And so what typically happens is we have a massive network of angel investors, VCs, private equity firms in our network. And so when these businesses and these founders are looking to raise equity capital, we often find ourselves putting them in touch with people who we think would be a really good fit for them. And so we don't participate ourselves in those, but we do help them get connected to the right people and people we think we can help them get in touch with.
Fantastic. And what a great resource to have. And just to speak to that, been doing this for obviously many years, I've seen, different solutions, more like when I see that financing with the R&D sort of financing, the way I've seen it happen with, and I'm sure this is exactly what happens with some of your clients, is that effectively that capacity to be able to extend that runway makes such a difference, because often being able to execute on some of those key milestones can make such a significant difference when it comes from a valuation standpoint, when it comes from what investors are expecting to see in a company. And, sometimes it is that additional 2, 3, 4 months that makes the difference when it comes to, to being able to achieve that. So I think it's an incredible offer, incredible solution for companies, because as I said, sometimes when you're getting technology developed, it doesn't always quite work on the time frame that you want. And as I said, so being able to create that a bit of an extended runway makes a difference. But likewise, then providing the opportunity for companies where effectively they may just prefer to go through the non-dilutive method of actual funding because it suits their business model much more, is also, I think, an exciting offer. And it's interesting for me, it's crazy to see how much this has grown over the last few years as an alternative to actually, basically bringing in venture capital into the company.
Yeah, seriously, we've seen, at least I've anecdotally seen, a very different change in narrative. Even, we only got started at kind of the beginning of 2022. And the narratives when speaking to founders then was quite different in that it was almost taboo to speak about a loan or debt. Although, I went to an event kind of leading up to Christmas, and I spoke to a lot of different founders there, and people were much more inquisitive about it actively. They'd heard about it. They'd heard about other founders using it. And they've also started to see kind of VCs themselves put out messages to say, like, here's how you can start thinking about debt solutions or alternative sources of capital. I think Australia has been in this situation where kind of all we've ever known over the last 10 or 15 years that the VC market started to pick up and startups started to really make some traction. We've only ever talked about equity capital. And so it's really something that's new. It's really something that's starting to become part of the conversation with shareholders, with investors, with founders around how you can actually look at different alternatives. So we're pretty excited about the future.
Well, Alex, thank you very much for your time, and congrats on what you built. I said we're excited from our side to be able to offer this to our clients and the companies that we get to work with, as I said, because for those factors that we've mentioned throughout this discussion is just play such an important role in helping companies sort of make those next steps and achieve those milestones, as well as whilst they're sort of building the business, building the value, and at the same time being able to access the capital they need. So well done to you.
Thank you.
Thanks, Alex.
Cheers, Steve.